Well, welcome back to the Small Business Mindset. The one topic I haven't yet totally taken a deep dive on this podcast is talking about commercial lending. And I know for a lot of small business users, this can either be an amazing asset and part of their toolbox or really, really scary because they haven't ever tapped into commercial lending before. But joining me today, I am pleased to have Jason Carter-Solomon on the podcast. He is the Senior Vice President of Commercial Banking with Landmark National Bank. And Jason offices out of the Kansas City market, but quite frankly, working with their bank over the years, they can help clients across the country. So just because we're here in the Midwest doesn't mean you can tap into him as a resource. And I will make sure to include his information in the show notes. So if you do want to connect with Jason, then please do. I'm sure he would love to connect with you. But Jason, welcome. Thank you for your time to join me today.
Thank you for having me. It's an honor.
So Jason and I had the privilege of meeting recently because we were taking a real estate investing course. And although, myself being in commercial real estate brokerage and Jason being on the lending side of that, I think this is an industry we're very familiar with. But I think it's a way we're always looking to ways to sharpen our saw and to be more cognizant about different methods and ways that we can utilize the financing vehicles to grow wealth, whether it's for ourselves or for our clients. And so I wanted to bring Jason on today to kick off, as I'm talking to my audience. And I have a lot of clients that either come to me in two different ways. They're either brand new business startups and they have never gotten a loan in their life. Right? Maybe they've never gotten a home mortgage or they've never applied for a line of credit, or they're ready to take the leap and buy a building. So they've never gone down that path. And then I have the other set of clients that are maybe a little more seasoned. They've done it before, or maybe they have a banking relationship. But I think, times change very drastically in both of our worlds, especially the economy. And so I want to get your lens on what's happening, what trends are happening. But first and foremost, can you talk us through if I am a brand new business owner and I am starting out and I have a need for lending, how should I come to you and what do I need to be ready for, as I'm showing up at my banker's office and saying, hey, listen, I need some money because I need to grow my business or invest in a property or invest in equipment. What does that look like?
Well, that's a great
That's a
question.
loaded question, right?
It's a loaded question. There's not a simple way to answer that, but we'll take a stab at it from a high level, 30,000 foot perspective. You know, One, I think folks who've never dealt or interface with a commercial lender may not understand um, the value proposition and or kind of the modality around engaging, right? Like what the banker's looking for, how the banker's thinking about things. Most folks tend to come to us if they're starting out in business with the lens of, hey, I've got a home mortgage. I apply for a home loan through a broker or through my bank, and I know that process. And so by default, they kind of narrow down to the simplest variables to evaluate, maybe get an apples to apples comparison. And oftentimes that's an interest rate, right? They go, hey, I need $100,000 and how much are you going to charge me? Because they're used to shopping for a product like a home. Well, commercial lending is different, although it can be, unfortunately, I think, commoditized. Your commercial banking relationship is a little bit different because there's nuance to what a credit need is for a business versus, let's say, a consumer. So I think in going and talking with a commercial bank, I think the first thing I would look for is find a relationship at the bank. If you're calling an 800 number and applying for a loan, line of credit, that's probably not going to yield the same level of success as it would within the consumer world. So you need to find someone, a human being to talk to. Find someone that has some knowledge and experience dealing with businesses like yours, that's familiar with your industry, understands your needs. Because oftentimes you'll find, hopefully, if you find the right banker, is that they're the best consultant you can get to help you guide your cash flow needs and go on that journey to help your business grow and help watch out for some pitfalls. But enough of that pitch aside, I think the next thing to look for with regard to a banking relationship, or you may need to be prepared for, is coming to the table understanding like why you need the money and the right use of the right type of lending and credit facility. right? Oftentimes people go, I need $100,000 line of credit. Well, why do you need $100,000 line of credit? Well, I want to go buy trucks. That not is not necessarily a suitable use for a line of credit in general, right? Because those are assets with some permanence, and a line of credit is a short-term financing vehicle, right? So it's a mismatch with regard to the payback cycle. Those trucks in your business, let's say you are a service company, they have a return, but the return is longer than a year generally, right? So
Right,
you
right,
need a
sure.
financing vehicle that is going to allow you to pay them off over the course of their useful life and therefore their payback cycle, right? Lines of credit or short-term vehicles. So what would a line of credit be used for? If you came to the bank and you said, well, listen, I go out and perform work for a host of customers. Unfortunately, I put out all the capital to perform the work, labor and materials, but I don't get paid for 60 to 90 days. I get paid. These people pay me. I trust them. They're going to pay me, but I don't get paid. But meanwhile, I have to put out all this capital. I have a huge capital outlay and I need to get it paid back, because if I don't get it paid back, then it inhibits me from going to do the next job or the next job or the next job, so on and so forth, or making the next widget or growing the next product line.
Or paying
That would be
staff
a
or paying,
pay staff.
yeah,
Exactly.
those
Those are
operating
the inputs that
expenses.
go into yielding the revenue. So what happens in that exchange when someone is selling something, they're creating a what's called a receivable. That is a short-term asset. It is almost in line and pari passu with cash, right? Because it's a promise to pay. Long story short, Universal Commercial Code allows you to collateralize that asset and then borrow against it. That is a line of credit. That, in most parlances, your line of credit is not like a home equity line of credit or a credit card to go buy whatever you want. It's for really a specific purpose. It's to finance the short term borrowing needs of the company between the time they have to outlay cash and receive cash, right? So like being able to explain to the banker why you need the money, that's really the first thing. And then the next thing is properly prepare financial statements, being able to show that, hey, I have my ducks in a row and I can show the bank with a degree of reasonable accuracy and certainty what my financial condition is. So I said a lot there,
Yeah.
right? And that's why I said it's not a simple answer,
Yeah.
but there's some simple things you can do, I think, to put yourself in good shape to succeed and
That's
get
exactly what I was
it.
going to ask you next. What should they come? So I know I work with people in all stages of business, and some of them like a brand new, some more seasoned, some might have been on some hard times. And I know
Mhm.
especially money is emotional, however much we think it might not be. But I also think it's a pride thing. And what I like to coach my clients is that whatever phase you're at, we realize that there are some bumps in the roads. Business changed. But I want you to, I'm so glad you talked about early on, relationships with your banker is probably, in my opinion, the most important thing. And having someone that can communicate like you just did and saying, this is the path we need to go on. What do you need it for? What is your, what does your future look like? But I always encourage my clients and like, be open, because the conversations they have with you are confidential. It's not like you're going to go and yell down the street, hey, listen, so and so just, did this or
There's
didn't do
banker
that.
client privilege. Yeah, I
Yes.
always tell folks that there's banker client privilege. We're not going to disclose to the world. You
Right.
can be vulnerable with us.
But bringing to the table, I'm like, bring it all, bring it all, because they need to see history
Yeah.
and they need to see what's happening. So what do they
Kristen,
need to bring to you? Yeah.
I'll speak to a point you just mentioned, and I think which is critical. You know, I think that's why the relationship matters, because you know I grew up as a middle market lender and then a small business lender, and long story short became a commercial real estate lender primarily at this point in my career. Um, One thing I will tell you is that just like in commercial real estate or a development project, which I'm sure you're familiar with, right, being in the CRE world, no project goes 100% smoothly, right? In business, nothing goes 100% as planned. So there are going to be hiccups. Trying to hide, shield, or ignore those and think giving only the rosiest picture to your banker or to any of your professional team really does you no service, right? And that's why relationship matters, because you need someone to hear your story. I always tell folks, be prepared to tell your own story, right? Warts and all. Don't rely on the banker to tell your story, right? Like, especially in commercial real estate, like, be prepared to tell the full story, the whole story, the truth, nothing but the truth to the banker, so that the banker can represent you and, frankly, advocate for you as best as possible. So you want a banker that gets it, understands the nuance, and can advocate for you. That's number one. And number two is, don't withhold information, because the worst thing, for me, I'm always saying, a colleague of mine always says, this business is about people, and people pay us back. Period. It's lending money to people, people pay us back. That's really it in its nutshell. So if I'm relying on someone to pay me back, right? Think about this scenario. And then I find out through my due diligence that there is something they were not 100% upfront with me about. Well, that starts a relationship off wrong. So it's
Yeah.
better to just disclose and cut to chase than try to just present just a rosy outlook picture, because we'll find it out one way or another usually. We're kind of like detectives in that way, and I don't want to scare people, but I mean, we read financial statements for a living, so we can kind of read through the minutia of a financial statement and understand what may have happened operationally.
Right.
And we want to help you reach your goals, even if you have had a hiccup, right? Like, it's okay for us to fall down in life. It's about how you get back up. And that's what a good banking relationship will help you do.
Right. That's fantastic advice. And I know I've some clients that have filed for bankruptcy, and they might have thought, gosh, that was years ago. Well, but that's honestly, as scary as that was. And even if you've overcome it, disclosing that up front, you're right. And being totally honest, because you're right, you're going to find it out. I mean, you got the best super sleuths in the world to go dig into credit and dig into financial history, and also, relationship history, and what has been the history of your company. Has it changed hands? Has it changed partners, ownership, staffing, all that kind of stuff? So I always encourage clients to look at, whether it's myself or their accountant, their banker. I mean, we're part of your team. I mean, whether or not you have a financial analyst or a CFO on board, this is part of your team that you need to have to make your business successful, which is incredibly important. So what should a client, when they're coming to meet with you for the first time, what should they have ready to bring financially to present to you outside of just a personal financial statement? What do they need to have ready?
I would say everyone needs to have their financial statements ready, right? And that what that means is, and there's two sides to that. Having your financial statements prepared in a way that is granular and nuanced to your business, accurate and timely, right? So having a professional level bookkeeper, CPA, right? If you're a QuickBooks guru, great, and you can crank them out, that's great. And if you're doing the debit and credit entries and you're able to do that, that's fine. But I think most business owners who are great practitioners, they have to major in something, and usually accounting is not it. They're good operators or good salespeople. So I find a lot of times people are trying to, when they're getting started, trying to save money on the wrong things at the wrong time. I think there's a time when you're keeping books in Excel, and that's probably okay. But as quick as possible, you need to offload that to a professional account. I've seen people that run $1 million, $2 million small businesses still keeping their books in Excel. And that's just not, I'm telling you, that's not acceptable. And that does not make you look professional to a
Right.
banker. You
Right.
need to have professionally prepared financial statements, balance sheet and income statement, right? Reconciled balance sheet means all the accounts are up to date and properly accounted for. You should be at that level on an accrual basis accounting system. So all the accruals need to be accurate. A lot of times you get folks and they don't properly balance those things in their balance sheet. They don't probably have the accruals built properly. That stuff makes you look not great from a financial standpoint, because that is a part of the risk we are taking. Is the information we're getting accurate? So that's one component of it. And the other component is, I think oftentimes there are a lot of, and I don't want to speak too ill of my brethren over in the accounting world or tax preparation world, but if you're going to H&R Block and having them do your small business return, I'd be very wary about the desire to have a aggressive tax efficient strategy versus one that is transparent uh, and effective in building wealth.
Right.
You might be wondering what I mean by that.
Please, I think I know what you mean, but please describe it for our
Let
listeners.
me explain. If your strategy is not to pay the government any taxes, that's your prerogative. There's no judgment. We're not going to the IRS. We're not somehow subcontract theirs. That's not my job. Okay. I am neutral on this issue. What I'm not neutral about is when I can't explain expenses running through your business that frankly may be discretionary and may not be needed for the ongoing sustainability of the business to defer profit, to avoid taxes,
Right.
but then you want to buy assets with leverage that you don't show profit for, right? So I like to say sometimes you're saving pennies, right? And missing out on hundreds of dollars, right?
True.
In exchange. So I personally believe it's better to have a mix of the two. But frankly, if you're thinking about wealth creation for the long term and growing your business, especially if you're in a business that's capital intensive, it's really tempting to get a lot of 179 deductions, right, on equipment before that equipment starts to cash flow and pay for itself.
Mhm.
I would actually advise people to really be careful there because part of your ability to go out and get leverage, get debt, is really tied to your ability to show that you can cash flow that debt.
Right.
And so having financial statements that are suitable to that end, I think is much more beneficial to your wealth strategy than saving a couple $1,000s in tax liability.
Yeah.
Does
That's
that make
fantastic.
sense?
No, that does make it
Yeah.
makes sense to me. And you put it very eloquently. And now I'm going to dumb it down. I think, well, I mean, because I would say I was in this position. I mean, 10 years ago when I switched, I was in banking before, not in lending, but in business development, and I was an employee, and we used TurboTax. We filed our
Mhm.
taxes.
I
We had a
have.
very yeah, we had a very simple return. I mean, it wasn't very complicated. I didn't have deductions and items. I mean, didn't have that. We had some
Yeah.
mortgage interest, but now being in business for myself, oh heck yeah, I have a CPA, because you're absolutely right. I think there's this misnomer that if I hire a CPA, there's all this extra cost. That's not true. I mean,
No.
really. I mean, I'm sure there's some accountants that work with very
Yeah.
large clients that they charge what they're worth, of course. But I would say, I'm so glad you said that. The value in hiring a professional, a CPA, to handle your taxes and handle the accounting practices absolutely saved me money in the
Yep.
long run and got
Yep.
really creative with me how I run my business. So
Yep.
great
Absolutely.
advice. Absolutely. Okay. I want to talk about trends because one thing I always get asked, especially from my more seasoned clients that have commercial loans and utilize those services quite a bit, it's all this like, the economy changes, the market changes. I know interest rates are up. What are you seeing from a banking perspective? What should we expect this year?
Boy, if I could answer this question with any reliability, I don't know that I'd be sitting here talking to you, unfortunately, Kristen. As lovely as this
Right,
conversation is, I'd
right,
probably be in Tahiti somewhere right now.
right.
Because it's $1 million question, right? What's happening this year? I think people are worried about recessionary pressures and inflation. Obviously, interest rates are going to keep increasing, and that's a macroeconomic, perspective or opinion. But I think the vast majority of business leaders would concede that yes, that is accurate. The question becomes how um, how reflect or how reactive will the Fed's actions be, and how either accelerated or decelerated will their follow through be in order to curb inflation? And I think that is going to play out very quickly in the first half of this year. 75 basis points became the new 25 basis points from a Fed monetary standpoint as far as interest rate bumps. We
Right.
saw that maybe peter off a little bit. I think we'll see that peter off this month with the Fed's announcement. But I think we're still going to be at a new normal. I don't know that we oftentimes price our loans based upon the 5-year treasury. the 5 year is actually dropping a little bit, which gives me a little bit of hope that perhaps, and this is just me, so no one can take this to the Broerial Bank and say Jason said this is happening, it's happening. But, there's something called the yield curve, if you're familiar with that, and that is oftentimes a leading indicator of whether or not we're going to be in recession or not, and it's basically a judgment of how people feel about risk within the marketplace. And normally, short-term money indices are higher than long-term money. I'm sorry, I said that the wrong way. Long-term money indices are higher than short-term money indices, right? Because, hey, I can get my money back in a 1 year treasury bill in a year, right? So yeah, I'll take a lower premium for that bond. 10 years, oh, I want more, right? Well, I think if the market feels that the Fed is working and lowering inflation, and we start to still see while the 5 years lowering, I think it's going to flatten out. And hopefully by the end of the year, we start to see the yield curve go from inverted, which means longer term money is less expensive than short term money. And that's because there's a demand for safety right now in the immediate term. Hopefully people start to feel a little more confident. So I think we'll start to see some normalization of rates towards the end of the year. And I think what that means for the marketplace with regard to lending is I think some deals will start to make sense again, right? From a real estate perspective, a lot of deals have not made economic sense because, frankly, they're trading at cap rates that are negative yield, right? There's a negative leverage between buying a multifamily asset at a 5 cap when rates are, I mean, prime 7.5 now, right?
Right.
So that doesn't make a whole lot of sense in the landscape of like financial risk. You wouldn't really want to do that deal unless you felt like you could raise rents at an accelerated rate to boost your cap rate above. I mean, well, at least your cash on cash above whatever that prime indice is, but or whatever your interest rate is. The other thing I think is that if we're entering a recession, it's different than what we've experienced, I think, most recently with regard to 2008. COVID was standing, skip over that because that's really was a synthetic situation.
Right.
The credit markets are flush with cash.
They are.
So there's not a credit crunch, right? Also, we're in a housing shortage. So while you might be tempted to think that foreclosures and defaults with regard to the housing sector will be on the rise, I don't think we're going to see that. I think we'll see prices normalize somewhat.
Right.
Transactions have started to peter out a little bit. I know from a multifamily standpoint, I'm not seeing as many as I did. However, I think people, are not going to get crazy deals. Like you're not picking up things. There's not going to be any picking up things at pennies on the dollar like
Right.
the last.
Right.
I think prices will stabilize, right? And there will be continued demand for multifamily housing and single family housing because we have, from a credit philosophy standpoint, kind of cornered ourselves into a shortage that I don't know that we're prepared to build ourselves out of in a hurry because we don't finance home builders like we used to. And I don't think that's actually coming back maybe ever. And that's actually a labor market issue more than even a credit market issue somewhat. I mean, it started with credit markets, but now it's become a labor issue. So those are my kind of high level predictions about trends in the marketplace right now.
Question I get too, and in addition to outside of just the financing aspect, is like, when's the good time to buy? Is it still a seller's market? Is it still a buyer's market? And what I like to tell them is that there's always opportunity in the market. And I'm so glad you described the yield curve versus the cap rate, because I know cap rate's an easy thing for commercial real estate investors or investors in general to look at as a simple equation, but it's subjective. Even though, you do a quick math problem and you get a cap rate, looking at that. Do you think, and I'm so glad you talked about, people are flush with cash in the market, it's flush with cash. I do have a lot of cash buyers right now, a lot of 1031 exchange buyers, but at the same time, I wonder, if they're not seeking lending, if they're cash because of the yield curve. But do you think even if someone's getting into a property and they're well financed, so you would do a deal that's I'm going to use your example, 5% cap rate but a 7% yield, is their intention then to see if the yield softens enough for them to then refinance or reposition the property and get the cap rate up? Do you think that's their strategy?
I think there's two types of strategies here. I think one strategy is that there are folks who have assets in their portfolio with loan maturities, right? What happens when you have rising rates, rising interest rates, and you bought in a low interest rate environment, and you have a potential for negative leverage, or let's take negative leverage out of it, because that can be a little bit of a, I don't know that I don't want to speak down to your listeners, but I don't know. There's a whole lot of minutia that can go into a negative leverage argument, because there are people out there that will still buy a negative leverage asset because of like what I just said. They believe that the inflationary pressures are in their favor,
Right.
that in the mid to long term, they will be able to raise rents, use end user prices because of inflationary pressures in order to catch up and increase their yield, so that the cap rate, even though they went in at, let's say, a 5, if it does go to a, let's say, interest rates are 5.5, well, they were negative leverage at 5 cap rate with a 5.5 interest rate. Well, if they get to 6.5 cap rate, because that's where the market adjusts everything, the rental rates have increased at such a velocity that their return is not affected.
Gotcha.
You know what I mean by that?
Yep.
Because
Yep.
they're able to raise rents on the users faster than monetary policy needs to raise interest rates. And although the cap rate, when it gets to the time they're ready to dispose, the disposition cap rate, that it's still going to be the same return. Like
Right.
they're gonna maintain return and still make money on the reversion of that asset. So that's a really, like, we could spend a whole lot of time discussing that. But I think, to get back to your question, I think there's two types of issues going on with regards to rising interest rates and the effect on how people move through a cycle. Well, if interest rates are rising and cap rates are dropping, when I say dropping, I actually mean raising, right? So a 7 goes to an 8, right?
Right.
So they're getting worse. You could say that to common language, right? People want more for more risk. Well, you have a situation where people are going to have to safeguard in their portfolios maturity loan risk, because the worst thing that can happen, and this happened during the recession, is that values are dropping because cap rates are rising. I might be paying my loan just fine, but then I
Right.
have an appraisal event in the middle of a recession, right? Interest rates have caused cap rates to rise. Economic situations have caused cap rates to rise. My asset's probably doing just fine. Well, the bank is going to come and say, well, you got a loan maturity. We need to appraise the real estate again. They come back with a value. You've lost $1 million in value. We're paying just fine, but we can only be margin 85% loan to value. You were at 80% when you started. You didn't pay down the loan because you had a 25-year amortization. Well, now you got to chip in $500,000 to remargin the loan. Nobody wants to do that, especially in syndicated deals, which have become more popular. Nobody's going to be able to go to their group of investor as a lead syndicator, as a GP, and say, hey, capital call, come bring me some money so we can pay down this loan. That's a kiss of death. No one wants to do that. So everyone right now, I think that they're smart. They're going to try to leapfrog over the recessionary period. I'm saying that I'm taking a long road to say something pretty simple. It's all about skipping over when you think the peak of the economic monetary pressure is going to happen, and thus the recession. So if you
Right.
can refinance now, get another 5-year term, and hopefully be past a recession, you safeguard yourself from a unknown but very serious risk with regard to having to remargin real estate in a downward cycle. Because right now we're not quite there yet. We haven't seen. I'm starting to see cap rates rise on assets. I mean, for instance, in office, I mean, there are some assets that I would say, just from my gut, over the last 5 years should be at a 7 cap.
Mm-hmm.
I just got a deal back in a very prominent area of town. I was shocked. Appraiser's telling me 8. It's an 8 cap. I was like, well, really? I mean, this is prime area. I mean, you can't get any better than this. And it's a really nice asset, class A.
Right.
And so,
Right.
right?
Interesting.
And that's trading at class A office is trading at 8 in prime
Yeah.
submarket.
Yeah.
Man, that seemed, I mean, that's almost 2008, 2009, 2010 stuff, So yeah, there's real risk coming. So I think people have got to get on the ball if they have that stuff in their portfolio. Now let's talk about the buyer side.
Yes.
On the buying side, on the acquisition side, I think there are going to be opportunities because what's going to happen is you have portfolio and institutional level buyers and also mom and pop investors that are frankly going to get a little worn out depending upon the asset class, especially in multifamily, or
Mhm.
maybe for some folks in your audience, even small density multifamily or single family portfolios. They're going to go, I'm tired of chasing rent. I mean, they won't have the stomach for it, right? They see the things coming around the road. The institutional folks are not emotional about real estate at all, frankly, because stock capital markets have dropped. They're now have an unbalanced portfolio, and their charge is to keep a balanced portfolio between real estate and equities. They're going to go, hey, I got to dispose of some real estate, and I'm going to dispose of it now while I can reap the benefit of a fruitful return that still meets my investment thresholds to my investors if we're in a fund. So they're
Right.
going to sell real estate now. I mean, now's the time. They're going to get out before it gets bloody and go, hey, let's just rebalance our portfolios and maybe even sit on cash for a little bit and then maybe go out and buy similar assets at a discount, right? So that presents a buying opportunity for folks that have been judicious about maintaining some cash and liquidity positions. And I
Gotcha.
think that's from a banking standpoint, that's what we're looking for is you might say, well, gosh, well, is the world going to slow down? No, I don't think it's going to slow down. I think there's going to be opportunity for folks to pick up some deals, not basement bargain, thrift deals, but some level of normalized pricing that we have not seen since maybe 2015, 2016.
That's great advice. I know I have a couple clients that to use the baseball analogy, they're like, really, I'm going after base hits. I'm going after something that I'm comfortable with, that I can control, I can wrap my arms around, and I understand the risk. And I'm so glad you mentioned having some cash reserves, because I know if you're someone that's in real estate investing, whether it's for your own business or you are strictly a real estate investor, I think you know how to play the game. And we sometimes come across economies where we can leverage those puzzle pieces and play them, play them with each other. But I'm also a proponent, like, make sure you have a good stash of cash for those reserves. You're right, because whether it's a margin call or something happens and you need to reposition your property, maybe need to do improvements before you can get those increased rent structure in. You can
Yep.
justify it, and I know you mentioned, office buildings and cap rates changing. I know it, especially in that world, making sure that you can command the rents you need to create the cap rate you desire to match what your yield curve looks like.
Yeah.
So
Yeah.
yeah, all
Yeah.
good
Even
things.
with that, yeah, even with office, I will add, a lot of folks have said, office is dying, it's dead. And while there's certainly some headwinds with regard to the office markets, especially within CBD, some markets within certain metro areas,
Sure.
ours notwithstanding here in Kansas City, I still think there is a tremendous opportunity for cash flow. Maybe not value appreciation so much, but I think office is still a worthwhile asset class for folks seeking yield
Yeah.
if you're prepared to do the heavy lifting
Yeah.
and you have to buy in the right submarket.
Yes.
So as a bank, we're not anti-office. We're very much, I would say we're almost pro-office as long as it's located well within the right submarket. Things on an island, not so much. Things within community corridors, neighborhood corridors that have natural amenities built in
Yep.
and have a good story to tell. Those are going to be fine assets, especially with smaller floor plates, because larger users are all looking to downsize.
Sure.
That's why the CBDs and the outlying island suburban submarkets are going to flounder a little bit because folks are going to say, I don't need 15,000 square feet. I don't need a whole floor. I'll take
Right.
half a floor and I got to get my folks back to the office. How do I do
Right.
that?
Yeah.
Well, man, if I'm in this little sub-market that's cute and has all these coffee shops and restaurants and has a grocery store and all this, maybe I can get folks to come back to the
That's a
office because
recruitment tool, hands down.
exactly,
Yeah. Yeah.
exactly.
Fantastic advice. Jason, as we're wrapping up today, I wanted to say thank you. I could go on talking to you for several hours, but that would dip way into your day.
Yeah,
But we'd love to have you back sometime soon. So I
absolutely.
just want to thank you again for our listeners. I'm going to put Jason's contact information in the show notes so everyone can call you and email you.
Yeah.
But Jason, you've been such a great resource for me, and I look forward to connecting with you again soon. And thank you so
Yeah,
much.
well, I appreciate it, and Landmark is a champion of entrepreneurs and small business, and so we feel it's our duty to kind of step in and be an advocate and help and assist wherever we can. And so we're always happy to support folks like yourself and all your listeners. So we're rooting for small business and entrepreneurship in the Midwest and America.
I love it. Jason, thank you so much.